This podcast is general in nature and hasn't taken your circumstances into account. It's important you consider your personal circumstances and speak to a financial advisor before deciding what's right for you. Any general tax information provided is provided as a guide only. Now, here's Shane and Deanna.
G'day everyone. G'day Deanna.
Hi Shane.
It just seems since the last time we spoke, which was just after the CPI came out in Australia, there's been a lot of talk about interest rate hikes in Australia. A day or so after, some economists are talking about rate hikes.
Well, I think only one economist.
Well, one anyway, talking about 3 rate hikes. And then we've got some retail sales numbers out the other day, which all look pretty soft. So what do we make of all this?
Well, I guess people are becoming concerned that we need another rate hike in Australia, and those economists that thought we needed more rate hikes the past few months were always of the view that Australian interest rates were too low compared to our global peers like the US, Canada, New Zealand, and that ultimately our interest rates had to get to 5% or above to sort of be in line, because in their view Australia was no different compared to the rest of the world in terms of the inflation story and the growth story. And our view has always been that Australia is different because the consumer is much more sensitive to rising interest rates. And I think that ultimately will prevail, because the retail data this week showed that the consumer is still struggling. Retail spending is up by only 0.8% over the past year to March. I mean, that's pretty low, the lowest annual rate of growth that we've had in retail outside of the pandemic and the time when the GST was introduced. And if you take that into per person terms or in volume terms, retail spending is still negative. So there are these pockets of weakness in the economy, mostly that are related to the consumer, I'd say. And I don't think that the RBA should be in any rush to hike again, because the retail data shows that we still have a lot of pressure for the consumer, and that's just not really in line with an economy that should be pursuing higher interest rates. I mean, the Reserve Bank will probably debate the need to hike rates again. But don't you think that the commentary that Michelle Bullock said in the last meeting around we're not ruling anything in or out, well, you could make the argument that they may discuss a rate hike because they're not ruling anything in or out.
I mean, I thought her commentary was fairly even-handed and allowed for the fact that they already raised rates a lot. I kind of think, yes, they want to preserve the gains on employment. So maybe that's one reason to not hike as much as other countries
And
have.
the labour market's been a bit stronger here
and
the
the
last
labour
few
market's
months.
been a little bit stronger here. But I take your point about the Australian consumer. In fact, you produced a chart which looks at the average mortgage rate on outstanding mortgages. So it's not the variable rate or the fixed rate, it's the average rate people are actually paying. It's gone up something like 3.5 percentage points in Australia. In the US, it's only gone up 0.5%. Because over there, you've got 95% of home borrowers on fixed rates for 30 years. So very different environment. It all reminds me a little bit of what Milton Friedman once said about, he had this analogy or a metaphor of a fool in a shower who constantly adjusts the hot and cold water taps, not allowing for the lags. And I think an example of that now would be to keep tightening and tightening and tightening. And the danger is that suddenly the full lag plays out and the cold water, if you like, suddenly comes through, and then we end up freezing and in recession. So my view is the Reserve Bank should sit tight, which I guess is what we're thinking going into the next meeting. You can't rule out another rate hike, and there's no doubt those inflation numbers were sticky. Flip side, of course, is that I'm also conscious that the last few quarterly inflation readings in Australia have consecutively gone through a phase where we're surprised that it's on the high side, then it's on the low side, the next one's on the high side again, September quarter last year, then it surprises on the downside, December quarter, now it's on the upside again. If you follow that pattern through, the next one will surprise on the downside again, which I think is another reason why the Reserve Bank should sit tight for the time being.
And then also the other argument that some of the areas where you're concerned about inflation, things that are related to housing like rents and construction costs, education costs that went up a lot in Q1, and medical costs or hospital services. I mean, they're not really areas that are demand related, but I suppose that from a central bank point of view, and I think that Ben Bernanke said this once, is that even though you might have all these supply issues, you don't want that seeping through into more of the demand areas. So they may still be worried about it, even though higher interest rates may do nothing actually to get inflation down in those areas.
Like that's a real challenge. And just thinking about housing, obviously demand is greater than supply in the case of housing, but there's not much the Reserve Bank can do anything about that. It doesn't control the number of the population growth, the number of migrants coming to the country. It doesn't control the release of land. It doesn't control all those things that affect supply and demand. And in fact, if it raises interest rates further and keeps going higher and higher, it could crash the economy. And maybe that solves the housing affordability issues regarding rents and prices. But longer term, it just makes the situation worse because we'll end up with less houses being built and a worse problem once the economy bounces back again. So that housing, I think, is a really difficult one, but it is, to my mind, it's something the government should be looking at both in terms of the demand side and the supply side. It's not something we can hope the Reserve Bank will resolve.
The next move we still think will probably be down, but later this year, November, maybe December, and I guess the risk is that it's pushed out into early 2025. But I think the Fed is also facing the same conundrum as the Reserve Bank, that the March quarter, the broad suite of data in the March quarter was a bit stronger than they would have liked, both in employment terms, the employment cost index, which came out this week, and inflation. So it looks like the chance of a Fed cut will probably also be delayed into late this year, if not early next year.
Yeah, it seems that way. I think if you go back earlier in the year, the Fed was talking about 3 cuts. Money markets were talking about 7 cuts, starting in March, in fact, and that's been progressively pushed out. I think the money market at the moment in relation to the US is September or November for the first cut. I think we've sort of leaned to the view it's probably going to be September. Yes, there's no doubt that the recent data in the US has disappointed. Stronger underlying economic growth, somewhat higher inflation. Even the wages numbers came in on the high side. But if you look beneath the surface, there's good forward indicators to the labour market, like the quits rate, and it's pointing down for wages growth. So I think ultimately the Fed will be able to cut rates. Again, it's just a case of coming a little bit later than one might have hoped. What does all that mean for equities, I guess, is a reasonable question. But the funny thing is that, yet again, we're seeing company profits in the US surprise on the upside for the March quarter. And so that's why you're not seeing share markets fall out of bed in a big way. You're getting volatility. April was a rough month, and that volatility is probably going to continue. But the strength in earnings is providing a bit of an offset to the high for longer story on interest rates.
And the increase in bond yields.
That's right. So negatives for shares, higher bond yields, higher for longer interest rates, or high for longer interest rates, but profits are coming in on the high side, and that's sort of providing a bit of an offset.
So the pushback in interest rate cut expectations, even the chance of hikes, should mean that we may see some weakness in home prices in Australia. I think a lot of people have been expecting some rate cuts this year, or hoping for some rate cuts, maybe pushing people back into the housing market, which is why we've seen home prices accelerate in the past 12 months. But some data this week on home prices still remained pretty strong. So are we going to see any weakness in home prices this year, do you think?
Well, it's an interesting question. Look, I've been too negative on house prices. Again, it's a case of the resilience of Australian home buyers.
But also the immigration story.
Also the immigration story. And I think that's the big factor that if you go back, 2 years ago, we had a budget in March 2022. I think the immigration projection for the year ahead was something like 180,000 and it turned out to be 500,000 plus. And for the year to September, immigration has been 550,000. Total population growth about 660,000. That's the latest period we have data for. And the monthly numbers since then suggest that it's probably peaking, but still very high. That if you divide it into average household size of 2.5 people, you get about underlying demand of about 250,000. Very, very high number, record high number. Only problem is over the last 12 months, completions have been running at about 170,000. So in just 12 months alone, we've made the housing shortfall worse to the tune of about 70,000 dwellings. And that's on top of an existing housing shortfall. And so if you're wondering why house prices are still going up, rents are still going up, well, that's basically the explanation, massive housing shortfall. Of course, affordability kicks in, both in terms of rents, there's only so much people can pay, and house prices. And interest rates, the longer they stay up, the more it's probably going to be a bit of a drag on home buyers. Home buyers will say, well, we were hoping to get a rate cut. Maybe that's not going to happen. Maybe I can hold back now that purchase, delay the purchase a bit. Alternatively, existing homeowners might start to struggle with their mortgages. So you might see an increase in distressed listings. So there is that risk. The longer rates stay at these levels and the risk gets added to if rates go up, that the property market may start to soften. There's some telltale signs of that. Recent data still fairly solid, up 0.6% in April, third month in a row of a 0.6% gain. National prices up, 8.5%, 9% over 12 months. Massive range though. Perth shooting the lights out, Melbourne dead in the water, Sydney sort of at the softer end, and many other cities as well. Adelaide and Brisbane also strong. So very diverse picture across the country. But there are some telltale signs of softening. Auction clearance rates in Sydney and Melbourne have cooled a little bit. Housing finance growth has been relatively subdued. Some like to look at the seasonally adjusted core logic data, and it was actually quite a lot weaker, suggesting a lot of the growth in the month of April was just seasonal. And I guess, when you ask Australians, the sentiment towards property is still fairly negative. So maybe it's starting to soften at the edges there. But our base case is now for gains of around 5% this year. Obviously, the housing shortfall suggests upside risk, but high rates and so on and poor affordability suggests perhaps downside risk to that, particularly if rate cuts are delayed for a lengthy period or we get rate hikes and as unemployment goes up.
Well, we seem to talk about happiness a lot in this podcast, but this week you put out a note about the economics of happiness, and one of the findings was that young people now tend to be a lot unhappier compared to other groups, and that's a bit of a change to 20 years ago when young people actually were the most happiest group. So what's happened? Is it because of wealth inequality, income inequality, a higher jobless rate, even though the labour market's very tight in Australia and in other major countries? What's the reason for this change in happiness in young people?
Look, it's a good question. Happiness has gone down generally in countries like Australia and the US, and that's despite more material possessions. So I guess just a reminder that money can't buy happiness, just as it can't buy love. That said, if I was ill or something, I'd rather have money than not. But the evidence suggests that basically above an income level of about $50,000, people don't get any happier. You go from being very poor to a bit of income, you feel happier. Beyond a certain level doesn't really improve things. But the observation about youth really surprises me. The United Nations, via the Gallup organisation, they put out this thing called the World Happiness Report from a group also in Oxford in the UK. And it found that happiness levels have come down in many developed countries, including Australia and the US, over the last 20 years. But it used to have a pattern where the young were very happy, middle-aged people weren't so happy, and then everyone gets happy again by the time they're 60 and over. And I think that's middle-aged angst and all the stresses of raising a family and so on. Now what's happened, it's really unfortunate, young people are the least happy age group. And there's lots of different theories behind this. I think poor housing affordability in countries like Australia probably are a factor. Perceptions of inequality, another factor. But one big issue seems to be the rise of social media. So in that 20-year period, we had the rise of the smartphone from 2007. Social media really took off in the early 2010s. And if you look at a lot of evidence regarding youth depression and anxiety and all those sorts of things, the negative situation really kicks in from the early 2010s. And one observation is that's when we went from kids who were outdoors playing in the sunshine to at home inside playing on social media, which had negative effects on them. And it does seem as if social media is playing a role here in making kids more anxious, giving rise to depression and so on. If you think about most religions of the world teach us to try and get our egos under control in some way as a way to get towards happiness, to get down our levels of desire, whereas smartphones and social media, not smartphones perhaps, but social media sort of pushes us to a direction where we've got to get more likes, see ourselves more on the social media and so on. And maybe that's a factor behind all of this, this decline in happiness for young people. But it's certainly a concern. It's the last thing you want to see. You want to see happy young people looking forward to their life, not what we're seeing. And that's showing up in increasing levels of depression, anxiety, and rising youth suicide rates, for example.
So just a reminder that everything you see on social media is not real.
It's not. A lot of it's fake news. But I think in reality, this is not about saying, well, I kind of think, well, how do we solve this issue? You can't solve it by, getting rid of the success which has given rise to social media. Social media.
And a lot of young people have had success by becoming TikTok influencers and these types of jobs that you never would have expected even 10 or 20 years ago.
And there's lots of positives there. And the very fact that we're richer now and can afford smartphones, we can afford the time to spend on them. We can invent the technology which has come up with all that stuff. That's the success behind this. The last thing you want to do is do away with the success and go back to being a subsistence economy. Well, we do need to find ways to live with social media, just as we found ways to safely, or as safely as possible, live with the car, for example. When the car first came along, it was seen as a big concern. And then we put rules around it, which ultimately made it relatively safe within reason. I think it's the same thing with social media. We have to find ways to live with it and not throw the baby out with the bathwater. So thanks, everyone. Thanks, Diana. Funny thing is, there's a rainbow right behind you.
Oh, it's gotten even brighter.
It's gotten even brighter, which tells us that things will get better.
For more info on Shane and Diana's podcasts and reports, head to the Insights Hub at amp.com.au.